Hi, JJ here with The Art of Value. Today I'm going to be talking about Ray Dalio. News has just come out with Bridgewaters investment results for the first half of 2022, which is very interesting. It's very good. And we're going to be looking at Ray Dalio, what he's been saying lately, like about the current market and economic situation, moving into a bear market, and three important things that have happened over history that he thinks are important and relevant today, and the risk of a financial crisis and civil war, which is pretty pessimistic, and going deeper for the investing in Ray Dalio nerds. We're going to be going deeper into a recent transcript of his interview and sort of covering all those topics in a bit more depth. So that'll probably be about after the 5-minute mark. All right, so let's get into the results, investment results. Let's see what Bloomberg had to say about that.
Bridgewater's performance, just as many other macro funds, we actually saw them struggle for years. How did they do this time around?
Right, so Bridgewater's had a pretty successful year in the first half, up 32%, in its main hedge fund, Pure Alpha. That fund rose nearly 5% last month, while the stock market fell more than 8%, so it's a pretty good return. It's been helped, as you mentioned, by the volatility we've seen in markets. They had some struggles earlier on. This gain does build on the Pure Alpha.
So up 32% in the first half, which is very good considering what's been going on. A lot of investors have been doing badly, but Bridgewater hasn't done so well over the last few years. But in this volatile market, their flagship fund, which is macro, I believe a macro fund, Pure Alpha it's called. Let's go on. Let's see what else they have to say.
For return last year when it was up about 8%, but keep in mind in 2020 that fund fell nearly 13%, and then for the 8 years previous to that they posted kind of a nominal annualized gain. So it's had a rough path for a number of years. They saw several institutional clients pull around 2020, so this year's returns are certainly good news for their investors.
So it was down 12.6% in 2020, while a lot of investors, so tech investors, were up, but some of those like ARK Innovation is down, way down. But Bridgewater's had a very good year so far. See if they've got anything else to say here.
How are macro funds more broadly faring this year?
Yes, so, macro funds had a really tough go for several years. They struggled because, previously there wasn't enough market volatility. They pointed to central banks having policies that were pretty similar, rates being too low. But now as we're seeing this increased vol around, rising interest rates, surging inflation, soaring energy prices, we're seeing tumult in both equity and bond markets. This is providing a lot of opportunity for macro funds to do well. And so we're seeing a lot of them flourish. If we look across one of the index.
All right. Macro funds doing well. I did a recent episode about Stan Druckenmiller. He's a macro investor and he's done very well over the decade. So I'm wondering how he's doing in this first half of the year. Certainly had a lot to say, and he was calling a bear market. So perhaps he's been doing well. Okay, next, moving on to what he's saying about a bear market. It's just a short thing about what he's saying about bear market in general.
Somebody said to you, okay, we are clearly moving into a bear market. How long do you think it will last?
I think that the Fed's trade-off between inflation and growth, it always tries to see a balance. And there are some times when conditions are good, usually when there's not much debt, that trade-off is not difficult to run. We're entering a period of time where there's an great inflationary pressure due to the fact that you produce so much money and at the same time they're trying to strike that balance of the tightening of monetary policy. So it looks to me like an environment like a stagflation kind of environment where both will be a particular challenge. So individuals have got to know, what does that mean? For example, interest rates and debt instruments that they're holding will not have a real return. They have that's adequate. In other words, not enough earnings to compensate for inflation. Last year we had an inflation rate of about 8%. There's a zero earnings. So if people start to think in terms of buying power and realize that cash instruments and debt instruments are going to be a challenge and try to diversify their portfolios, those would be the main headlines that I'd convey in terms of, don't just look at up and down in bull markets and bear markets. Look at diversification and be very particularly worried about whether the real returns that you're going to get on your cash or your bonds. I think too many people are not worried about that kind of environment. If you even study the 70s or other periods of time like that, that would be helpful.
All right. So he thinks we're going into a bear market environment. Sorry, turn that off. And diversification is key. So he sees, inflation basically lasting a long time. He talks about the 70s environment where there wasn't persistent inflation. So he seems kind of concerned about the bear market. All right, next up, we're talking about 3 important things that have happened many times in history, which he thinks are of concern today. He talks in his last book, very long book, about long-term, short-term cycles and long-term cycles. So that's what he has to say about it. It's called 3 important things that happened many times in history.
There were 3 things that are happening now that didn't happen in my lifetime before and that I needed to study. And that was an enormous amount of creation of debt and the monetization of that in a financial piece. The second is the internal conflict, populism of the right and the left, and with wealth gaps and so on, that I like to measure things, that you'd have to go back to 1900 to see those degrees of conflict, which I think are a threat to our system and a democracy and could produce a civil war type of situation. Right. And third, the rise of a great power to challenge an existing great power in the existing world order. Now those 3 things in their degrees individually, but also collectively, last time they happened was 1930 to 45 period. And so what I needed to do was to understand those patterns and those things.
Okay, wow. So he talks about possibly going into a civil war type situation. He sort of explained other places where he doesn't mean like like it was before. Obviously it'd be different, but possibility of some real conflict there. So one last video, the risk of a financial crisis and war. So he goes into it a bit more. This is a very short video.
These empires, these dynasties, going back since the last 500 years. And you see the same thing happening over and over again. When there's a financial problem, when the granaries are empty and the coffers are empty, they print money. And when they print money and the coffers are empty, it devalues money. And with that, when you have a large gap of people at each other's throats, then you create a risk of an internal conflict, a risk of some kind of civil war. And that is what I think is we're at risk of. I've studied these empires.
Okay, there you go. Financial crisis and civil war. So you'd have to say it's fairly pessimistic about the next few years. And now for the next part of the episode, I'm going to go further into the transcript where he talks about that stuff more in depth. It's from a recent interview which I did a separate video on with Ray Dalio and Jeremy Grantham, an interview and conversation with each other, sort of going backward and forward about the same subjects. But I'm going to isolate what Ray said in there because this one's about Ray, all about Ray. And yeah, let's get into it. So he says, part of the lessons he learned early on, he said surprises happen. Even though he's predicting all these things, sort of pessimistic, he says surprises happen, especially with the market, saying that when he was younger, I think he said about 30, surprises happen where Nixon severed the relationship between gold and the dollar and essentially defaulting. And that day he went into the market thinking that it would be down a lot, but it went up a lot. So you never can predict what actually happens in the market. But he is talking about the macroeconomic situation here. So three big things have happened in his lifetime. See, every time he's been talking about these things with his research, the amount of internal political, economic, social conflict that is going on, the rise of a great power to challenge the existing world order, China, and the geopolitical situation that's developing, the US becoming less dominant than it has been in recent decades. He's done a lot of research over the past, looking into the past 500 years of economic and political events, really. So he's found the rise and decline of currencies and the empires along with them. acts of nature that have bigger effects, even with wars, droughts, floods, pandemics. He thinks climate change will be a factor there, and Jeremy Grantham was obviously in agreement there. And humans have the capacity to adapt and invent things, but the big cycles and events are dominant throughout history. That's what he found in his research. So how are the trends? He was asked how are the trends you have been describing likely to play out in the next 5 to 10 years? So we're going more in depth here over how he thinks it's going to play out. He's mentioned stagflation in that short video. This is year 3 of an aggressive monetary expansion. There's a lot of inflation pressure at the moment. It's over 8%. Everybody's long, wants everything to go up, and it creates a dynamic where everything went up. And there's the strong term business cycle of 77 years on average he's found in his research. But he seems to think we're moving a bit quicker at the moment than a 7-year cycle. So we're going to be in a tight environment, and that changes everything, he thinks. Tight monetary environment and returns of equities and well-being of companies. You have to think about the returns on equities. I think he says being lower. Rising rates creates a squeeze on equities. There we go. And there's changes in the economics, and the cost of debt is also changing. So he basically thinks that could push asset prices down for an extended period, keeping in mind that he might be wrong. There's a shock, a punch in the face, as Jeremy describes. And in the interview, Jeremy's described what he's described as a super bubble, which I might do another episode on soon. And things everyone believes in, the tech companies, like the tech bubble, they get hammered, like minus 75% decline in Cathy Wood's funds over the past, since February 2021 to be exact. That causes the adaptation. Adaptation? No, I've written that down wrong. It's adaptation. We're at the beginning of that. It's most similar to the 1970s period, he thinks, where he's explained before. So he's reiterating this in this longer interview. In 2022 election, we'll have a big impact. He thinks the next election will be important, and this is interesting. Thinks we're in a greater political extremism where moderates are leaving. There are lots of populists from the both left and right, not just the right, and there's a risk the system is in jeopardy because of extremism, with people not accepting losing the US and Europe in that position. So he said elsewhere that he thinks that the next election could be that whichever side it is losing won't accept it, and that could cause instability. I don't know how he's predicting that, but it's will be interesting to see, won't it? It'll be important to diversify well and be long and short different assets in order to perform well in that environment. So he's looked at the environment. He's saying how do we invest through that? He says cash is trash, which has been a headline that he's said for quite a while now. Bonds and debt aren't going to be good. Claims on financial assets. Either avoid those, position yourselves for inflation and assets going down. When he says claims on financial assets, he means kind of asset prices. They're just it's on paper, right? So it could go down and then it disappears. I agree with Jeremy on commodities. Companies adapt to the commodity cycle. You have negative real returns in that environment. So I'll just go back to that. I agree with Jeremy on commodities companies. So he's talking about a commodities super cycle there, that it's not may not be a bad place to be. But again, we just don't know. It's a prediction. Separate alpha and beta, how to create balanced core portfolio in that environment. So he's sort of saying you could reduce risk and raise returns by having rising inflation investments. Rising inflation. So investments that do well in a higher inflationary environment. That's largely missing from portfolios now, from generally. And it's interesting that their portfolio went up 32% this year, so must be doing something right in terms of how they're positioning. Would be very should be very well diversified, he reiterates again, and the social and political conflicts will be big investment thing in coming years. It will affect investments, he thinks. We need places with good income statements and balance sheets, including countries and companies, and that can weather through those things. And they're also civil with each other. So parties that are civil with each other, internal conflict and bad finances are going to be defining characteristics of where to invest or even where to be physically. Am I going to have a risk of being in a international war? Actually, that reminds me, yesterday I was listening to a podcast on the podcast network. Is it the podcast network? TIP, the investment podcast. And I was a long interview with Guy Spear, who was talking about living in Switzerland. One of the reasons he lives in Switzerland is because his kind of history, his family history, and sees it as a safe place. And similar to Dalio saying that there's a risk that the US could get into kind of political real problems. But that's being super cautious. It would. So he says, am I going to have a risk of being in an international war? ? It would raise lots of threats, lots of parts of the world that are not as plagued with this. So he's talking about emerging Asia, India, diversify there, look at neutral countries during that time. Neutral countries, Switzerland. It was neutral during the last war. Watch out for government controls on capital markets, so he says. The logical next step is, as history shows, that the governments start to clamp down on capital markets, and at times I believe they've banned gold during high inflation. Confiscated gold even. That happened in Germany. Don't quote me on that, but I think I did read a book about hyperinflation in Weimar, Germany, and they did basically confiscate gold, I think, at one point. Think in storeholds of wealth, but not cash. Must be able to move it from country to country. Cash is trash. So assets that you can move. People are going to say Bitcoin there, aren't they? Think in storeholds of wealth, but not cash. Must be able to move it from country to country. Yep. Cash is trash. So because inflation will eat away at cash, the value of cash during high inflation. All right, that's the end of that. I hope you got something out of that. It's interesting. And if you did get value out of it, subscribe on YouTube and follow on other podcast apps that you can, Spotify, Apple, wherever you are. And join me on Twitter at The Art of Value. And at the end of this video, have a look at the videos that YouTube does recommend to watch. And go back and listen to Jeremy and Ray talking in an interview if you're interested in that. See you next time.